Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Israel announced yesterday night that it had begun targeted ground raids in southern Lebanon, escalating its campaign against Hezbollah. This development adds a new layer of geopolitical tensions. Meanwhile, China's benchmark index posted its biggest gain since 2008, and the three cities relaxed rules for home buyers and various stimulus packages announced. In the US, bond yields climbed higher, led by the policy sensitive 2 year note trading around 3.64%, following Fed Chair Jerome Powell's remarks that more data is needed before making a decision at the November meeting. Good morning, JK. A lot of factors playing out. My question, we have been seeing dollar hold on to its recent lows and not breaking down. Do you think there is some sort of basing that's happening at these levels?
Hey, good morning, Swaraj. Yes, this is the point that I've been trying to make over the last few days. Uh, you know, we have had numbers from US that was beating expectations, particularly on the jobless claims, the consumer confidence data, GDP, and some manufacturing indicators as well. But still, dollar has been trading at its lower levels. And even more surprising was why the euro was trading near its 1 year high, while all the data suggested that major nations in euro regions are slowing down much more than the US, in fact. And eurozone inflation is much closer to the ECB target. The yield difference between US and German bonds, which had tightened till August, has already widened by more than 50 basis points. So it was always going to be a matter of time before market adjusted to the reality, and a decent reversal in the single currency is still awaited. But at least yesterday we have seen another failure at 1.12, and the currency quickly dipping to 1.1120 in New York trading after the German inflation came much lower than expected. So it's almost a certainty that ECB will cut again in October. This is the third cut they would be making in the policy rate, and that along with the US, Jerome Powell's statement yesterday that actually moved the market quite a big way, in particularly in the bond section. And we have been also pointing to the fact that while inflation has been lower, the other data did not really suggest that the market was, the economy was in a very slowing phase. And in fact, Powell said the economy seemed poised for a continued slowdown in inflation, and that the jobs market remains solid and risks are two-sided, and that the central bank does not feel like it is in a hurry to cut quickly. And he even said that we are not on a preset course as far as the rate hikes are concerned. And two important fallout of his statements. One, the yield on the 2 year paper, which is sensitive to the rate hike or rate cut adjustments, was seen rising by 11 basis points. Now it is trading at 3.66, and a 10-year had a mild upside on the upside. And the expectation of rate cut in November has now shown less than 50% probability of a 0.5% cut. This is the big change that we saw yesterday. And this also, along with the lower German inflation, added to the euro coming off, and in general, dollar rising a bit. Although, the commodity currencies have been holding on because of the big moves that we have seen in the Chinese market. China market yesterday actually rallied by more than 7%. And what we also saw yesterday, interestingly, many markets giving up good amount of gains, including India, in fact. And at the same time, Chinese market gained more than 7% in a single day. The total gains in the last 1 week, reaching nearly 18 to 19%. And of course, Chinese markets are closed for a week from today for Golden Week holidays. Perhaps a lot of people did not want to miss out in case the Chinese government or the central bank were to come out with more measures and the market gaps up once again. We also seen statements from some of the big funds indicating that they're going more overweight on China, expressing more confidence in the measures that the Chinese government has announced for supporting the economy. So that maybe in the coming days we will see correction in some of the overvalued markets, particularly in the Indian market, in Japan, and also the US S&P, which can in turn see the Chinese being balanced by Chinese market going up. So the overall, we have seen stock markets showing some shift in the yields, which we have been observing as bottoming out near 3.55 for 2 year, have moved up, and then we are back to watching more data from US. And important, we will have the ISM manufacturing data from US that will be, you know, key for determining the business activity level in the economy and also the employment situation in the manufacturing. Yes, as you said, the geopolitics has been reaching a very flashpoint. However, like the indications on the economy, markets have been ignoring even the geopolitical developments. And in fact, yesterday we have seen gold correcting more than 1% once again. It does appear that market is quite complacent, and if we do see a big eruption and a larger scale war involving bigger powers, then I think we can see a sudden caving in the market, and that is what the risk that we are running right now. Yes, market is ignoring these things now. As far as the Indian market is concerned, there's another day when dollar rupee remained bid, but it was on the back of a good reason that we saw one of the largest single day outflow from Indian market of more than 9,000 crores. And so it was not surprising that dollar rupee traded another 10 paisa higher compared to the previous day's range. And on the fundamental side, we also saw the Indian current account data also coming slightly wider at 9.7 billion deficit, or 1.1% of GDP, as against 8.9 billion or 1% a year ago. In fact, for the previous quarter, we had seen a small surplus, but this number has come on the back of wider trade deficit that we have seen in the quite Q1 of FY25 as compared to the 1 year ago period. And even the services activity, has brought in lesser surplus compared to the previous year. So, of course, we can see a big jump in the remittances by Indian diaspora. The private receipts have increased substantially to 29.5 billion from 27.1 billion witnessed in the same period of last year. So it is a trade deficit. Of course, we also know that the trade deficit has recently gone up more due to gold and silver imports, and this may be corrected in the coming months. But overall, the current account turning from surplus to a marginal deficit, it's not a worry as far as the Indian rupee is concerned. The short-term moves are determined by the flows, and that has been negative for last couple of days. And we are into a new month and a new quarter, so we will observe the flows in the coming days as well as the dollar index trend for seeing how the dollar rupee makes its way further. Thank you.
Thank you, Jack. And just quickly summarizing some themes which you mentioned, especially in the US market, while inflation has been coming down, the growth and job market seems pretty solid to avoid a recession, at least given how the data has been printing recently. Euro has seen another bout of selling from 1.12 levels. Even the German inflation was lower than expected. Markets now price a cut by ECB in October. Chinese equity markets rallied. However, many other markets, even India, gave up their recent gains. Chinese markets will be closed this week for their Golden Week holiday. And interestingly, many funds are now going overweight in China. So there may be some fund reallocation that may come due to this shift in narrative. Gold corrected more than 1% yesterday, despite the geopolitical situations. And India rupee weakened as market saw the largest single day outflow of rupees 9,000 crores. Even Indian current account data came in slightly wider at 1.1% of the GDP. To recall, just a few days back, the trade deficit was had also printed wider. That's it from us today. Thanks for listening. Tune in on Thursday for another round of fresh updates from the markets. Thanks for listening.